There's a company in India that most retail investors probably don't think about when they talk about the stock market. You don't see its products in supermarkets. You don't see huge advertisements everywhere. In fact, many investors may not even recognize the company when they first hear its name. But here's what makes this interesting. As more Indians start investing in mutual funds, using financial products and moving their savings into the financial markets, there is a whole ecosystem of companies working behind the scenes. And one of those companies has seen its revenue and profits grow dramatically. Its return on equity is above 20%. Its debt is almost negligible. And it is generating positive cash flow from its operations. But there's a twist. The stock has already gone through a major correction. It was trading around 1,380 rupees in June 2025, and later fell to around 880 rupees. So what happened? Did the business become weaker? Or did investors simply become too optimistic and push the valuation too high? And could this correction actually make the stock interesting again? The company I'm talking about is KFin Technologies. And today, we're going to look beyond the stock price and understand the actual business. We'll look at its revenue, profits, return on equity, debt, cash flow, growth opportunity, and, most importantly, the risks you need to understand before considering this stock. So let's start with the business itself. What exactly does KFin Technologies do? KFin Technologies operates in financial technology and transaction processing. In simple terms, it provides technology and infrastructure that helps financial institutions manage investors, transactions, records, and financial information. Its business is connected with areas such as mutual funds, asset management companies, insurance, and pension-related services. Now think about what's happening in India. More people are investing. Mutual funds are becoming increasingly popular. Systematic investment plans are attracting millions of retail investors. And people who once depended mainly on traditional savings are gradually moving toward different financial products. But there's something that most people don't think about. Every new investor creates more financial data. Every transaction has to be processed. Every investment account needs to be maintained. And financial institutions need technology to handle all of this. That's where companies like KFin Technologies can benefit. You can think of KFin Technologies as part of the infrastructure operating behind India's growing financial ecosystem. You may not see the company directly, but its technology can be working behind the scenes for financial institutions serving millions of investors. And that gives the company an interesting long-term growth opportunity. But a good story isn't enough. When you're analyzing a stock, you have to move from the story to the numbers. So let's look at the financial performance. According to the analysis we're using, KFin Technologies' revenue increased from roughly 405 crore rupees to around 1,334 crore rupees. That's a significant increase. But revenue alone doesn't tell us enough. A company can increase sales and still struggle to generate profits. So let's look at the bottom line. Profit after tax increased from approximately 58 crore rupees to around 332 crore rupees. That's a huge improvement. And this is important because investors ultimately care about the profits a company can generate and the cash those profits can produce. So when both revenue and profit are growing strongly, investors naturally start paying attention. But now let's look at one of the most important profitability measures. Return on equity. In simple terms, return on equity tells us how efficiently a company uses shareholders' money to generate profits. KFin Technologies has a return on equity of around 20.5% according to the analysis. That's a healthy number. It tells us that the company is generating a meaningful return on the capital provided by its shareholders. But there's another part of fundamental analysis that we can't ignore. Debt. And this is where KFin Technologies looks particularly interesting. Its debt-to-equity ratio is around 0.03. That's extremely low. Why is that important? Because debt can become a major problem when a company's profits slow down. Imagine a company whose profits suddenly fall while its interest payments continue increasing. It can quickly come under financial pressure. But a company with very little debt has much more flexibility. It can invest in growth without carrying a huge financial burden. And that's another positive point for KFin Technologies. So far, we have strong revenue growth, strong profit growth, a healthy return on equity, and very low debt. But there's one more question. Are those profits actually turning into cash? Because this is something investors often overlook. A company can report accounting profits, but if those profits aren't translating into cash generation, that's a warning sign. According to the analysis, KFin Technologies has maintained positive operating cash flow. That's encouraging because it indicates that the core business is generating actual cash. So at this point, everything seems quite attractive. Strong growth, healthy profitability, low debt, positive cash flow. But then we come to the part that makes this stock much more interesting. The share price. KFin Technologies traded around 1,380 rupees in June 2025. Later, it came down to around 880 rupees. That's a significant correction. And whenever a stock with seemingly strong fundamentals falls this much, investors naturally start asking questions. Did the business collapse? Did profits disappear? Did debt suddenly explode? Or was the stock simply too expensive before? And this is one of the most important lessons in investing. A falling share price does not automatically mean a bad business. Sometimes the business continues growing. Revenue continues increasing. Profits continue increasing. Cash flow remains positive. But investors had simply paid too much for the stock. When expectations become more realistic, the valuation can fall. And that's exactly why you should never analyze a stock by looking only at its chart. You need to look underneath the chart. What's happening to revenue? What's happening to profit? Is return on equity improving? Is debt under control? Is the company generating cash? And most importantly, is the business getting stronger? A stock falling 30 or 40% does not automatically mean it's cheap. It could still be expensive. And that's the biggest risk we need to discuss with KFin Technologies. Valuation. A company can be an excellent business and still be a poor investment if you pay too much for it. Think about it this way. Imagine you find a beautiful house in an excellent location. The construction is perfect. The neighborhood is fantastic. But the owner asks you 5 times what the property is actually worth. Would you still buy it? Probably not. The same principle applies to stocks. The business can be excellent, but the price matters. And with KFin Technologies, investors need to pay close attention to how much future growth is already reflected in the valuation. If the company continues growing rapidly, today's valuation could eventually look reasonable. But if growth slows down significantly, investors may become unwilling to pay the same premium. And that can put pressure on the stock price. So what could drive KFin Technologies forward? The biggest opportunity is India's growing financialization. More people investing. More mutual fund accounts. More systematic investment plans. More financial products. More digital transactions. and more money entering the financial markets. All of this potentially increases the amount of financial data and transactions that need to be processed. And that's the long-term story behind KFin Technologies. But there are risks as well. If India's financial market growth slows, the company's growth could also slow. Competition is another risk. Financial technology is a competitive industry, and companies have to continuously invest in technology and maintain strong relationships with clients. And then we have valuation risk. Even if the company continues performing well, the stock doesn't necessarily have to rise if the market has already priced in too much future growth. This is something every investor needs to understand. A company's business performance and its stock performance are connected. But they're not the same thing. A company can report good results and the stock can still fall. Why? Because the market isn't asking only whether the results are good. It's asking whether those results are better or worse than what investors expected. And expectations can change very quickly. So let's bring everything together. KFin Technologies operates in an industry that could benefit from India's growing financial ecosystem. Revenue has grown strongly. Profit has grown significantly. Return on equity is around 20.5%. Debt is extremely low. Operating cash flow is positive. And the stock has already experienced a major correction. That's certainly an interesting combination. But I wouldn't look at this and immediately say, buy the stock. That's not how fundamental analysis should work. Instead, I would put KFin Technologies on the watch list and continue monitoring the business. Are revenues continuing to grow? Are profits continuing to grow? Is return on equity remaining healthy? Is debt staying under control? Is cash flow remaining positive? And most importantly, is the valuation becoming reasonable compared with the company's future growth? Those are the questions that matter. So, is KFin Technologies fundamentally strong? Based on the numbers we're analyzing, there are several positives. Strong revenue growth. Strong profit growth. Healthy return on equity. Very low debt. And positive operating cash flow. The business also operates in an area that could benefit from India's long-term shift toward greater financial participation. But there's one thing you should never forget. A strong company isn't automatically a strong buy at every price. The price you pay matters. The valuation matters. And your investment horizon matters. So instead of asking, is KFin Technologies a good company? Ask a better question. Is the current market price attractive compared with the company's future earnings potential? That's the question I would be watching closely. Now I want to hear from you. After looking at the company's growth, profitability, return on equity, debt and cash flow, do you think KFin Technologies deserves a place on your watch list? Would you consider buying after the correction? Would you wait for a better valuation? Or do you think there are better opportunities in the market? Tell me what you think in the comments. And if you enjoy simple, data-driven stock analysis, subscribe to Retail Go Pro. Because here, we don't just look at whether a stock is going up or down. We look at the business behind the stock. Thanks for watching, and I'll see you in the next one.